I know people will continue to filter in, but I think we are at the point where we shall begin. Let me start by welcoming all of you to this latest CEPR Central Bank Communication webinar. We're delighted to welcome John Steinsson, who is going to present his work. Well, actually, it's got a slightly different title because it's the work he has with Leland Farmer and Emi Nakamura. But I saw it presented a while ago, and I thought there's some really important implications of this for people who think about central bank communication. And so I asked John, and John actually was very kind enough to even do some of that thinking himself. So he will talk a little bit on the link between that work and the issue of central bank communication. We also owe a special thanks to John because, of course, he's gotten up at 7 in the morning in order to give this. So for those of us who are enjoying our mid-afternoon break in Europe, thank you, John. We appreciate your early start to talk to us today. And without further ado, I'd like to hand the floor to you. We'll have questions coming in from people on the webinar via the Q&A function. There's also a few people here on the panel who may have questions, and they should with reasonable care to find a breaking point in your narrative to ask questions as and when. You can always defer questions till later, and then when we finish, we'll tend to have we have a hard stop after 1 hour and 15, so we'll adjust questions at the end to fill that time. And otherwise, thank you, John, and over to you.
Thank you for inviting me to speak at this forum. I'm going to be drawing on joint work with Leland Farmer and Emi Nakamura, a paper titled Learning About the Long Run. But I wanted to start by briefly talking a little bit about the current situation. Now, earlier this year, I proposed that the Federal Reserve in the United States should raise interest rates by 50 basis points at each of its next 4 meetings. So for a total of 200 basis points. At the time, this was considered quite radical. And I got a lot of pushback about this proposal at the time. And one of my good friends that I respect a lot, he asked me a perfectly reasonable question, which is this proposal of yours, is it based on a model? And I said, no. And he asked another quite reasonable question, which is why not? And I had several answers to that question. Some of it has to do with the forward guidance puzzle. But the most important reason in my mind why the models we typically use are not very useful for thinking about the way in which the speed of the tightening this year in the United States is that I think what's going on right now has a lot to do with the Fed's risk of losing credibility. And that notion is typically not captured in our models. Okay, so our models typically make very strong assumptions. Typically, it's either perfect credibility no matter what, or no credibility at all. Obviously, this issue of losing credibility, maintaining credibility, making sure the public believes that you're going to do whatever it takes is very much a matter of communication, but this is very hard to model. I think it's useful to think through the Phillips curve a little bit to understand this a little bit more deeply. So here I'm putting up a standard new Keynesian Phillips curve where inflation is determined by expected future inflation, an output gap, and supply shocks. Some manipulation of this equation can get you to this equation. I've just basically manipulated the first equation and I can get to the second equation. And that really, I think, brings home very starkly the importance of communication, because you see here that current inflation, according to this theory, moves 1 for 1 with expectations about inflation in the very, very long run. Okay, so here I have expectations today about inflation in the infinite future. And the coefficient on this is 1. So according to this theory, inflation moves 1 for 1 with beliefs about inflation in the very long run. Okay, so there's a sense in which this is the elephant in the room. A key determinant of current inflation is long-run inflation expectations. These long-run inflation expectations were very unstable in the 70s and 80s, and then they became anchored and have been anchored since the late 1990s. But how do we kind of influence this object, right? That is a matter of communication, and it's actually purely a matter of communication, I would say. Okay, so this is beliefs about something in the far, far future, and it's a purely nominal variable. It's not anchored in any way by anything real, right? It's all about what people believe the long-run monetary policy of the central bank is, and so it's totally up to the central bank and you know the political equilibrium in general to give people beliefs about this. It's you know, it's very hard to think about how this moves around, how you anchor it, how it gets disanchored, and so on. And our models typically, as I said before, make very strong assumptions about this kind of an object. You know, typically in our models, we write them down in such a way that the private agents in the model know the policy rule, and therefore they know what the Fed is going to be doing in the very long run. So typically this kind of an object is a constant in our models. And so that's like throwing out most of the action in my view. Okay, so communicating about the very long run policy is of course particularly difficult. But arguably, even communicating about relatively short-term policy is quite difficult, at least if one looks at the history of the last 40 or 50 years. I would argue that the Federal Reserve has been, has been spectacularly unsuccessful at communicating its short-term policy path. So here what I'm showing you is a figure that the black solid line is the evolution of the 3-month Treasury bill rate, so something very close to the federal funds rate. And the whiskers that come off the line, they are professional forecasts of the 3-month Treasury bill rate at each point in time. So for example, this whisker here is telling you that what professional forecasters believed would happen to interest rates going forward was that they would rise, while in fact they fell. Okay, so if I produce the same figure using forward rates from the bond market, it would look very similar. So I think the takeaway from this picture is, or one takeaway from this picture, is just how incredibly unsuccessful the Fed has been at communicating to the public what it was going to do going forward. So, take this easing episode here. Okay, so throughout the entire easing episode, the public believed that the Fed was going to start tightening almost immediately. Here's another one of these easing episodes, same thing happens, right? Here's a tightening episode where the private sector it did understand there was going to be some tightening, but totally missed the speed of the tightening. That happens again here in 2000. The private sector believes essentially nothing is going to happen to interest rates, but there's a sustained tightening cycle. Here's an easing cycle again, the same thing. They don't get it, right? Even over here.
John, can I ask? Because an alternative is that the Fed has been spectacularly unsuccessful at knowing where it's going to go. Charles Goodhart recently said this about his time on the MPC, that he was always surprised by how at every meeting they thought they had made the right decision and it would get things back to target, and yet they would come back 1 month later and be surprised at the fact that they hadn't done enough and they had to do more. So how does that balance?
No. I think that's right. That particularly early on, that is probably a non-trivial part of the story. Okay, but I'd argue that some of this later stuff is maybe not quite like that. Like take 2009. Do we really think that the Fed thought in late 2009 that they were going to lift off 3 months later when the unemployment rate was like 10%? Well, the market thought they were going to lift off within 6 months, and they continued to think that until in 2012 the Fed explicitly said to the market, no, we're going to keep it here until late 2014 or whatever they said at the beginning, right? And then these forward rates collapsed. So I think it's a combination of those two things. The central bank hasn't known what it was going to do, but of course, to the extent, if that's the whole story, it's like very spectacular how little understanding there was of the Fed's own policy reaction function, even inside the Fed. But certainly the private sector had literally kind of no idea what the policy reaction function was for most of history. So another thing that you can take from this picture, and I think the traditional thing that people have taken from a picture like this is the notion that these professional forecasts, they seem to display pretty large anomalies. Okay, so they're biased. The forecast errors are autocorrelated. And there's a long list of these anomalies. So let me give you a little bit of a quantitative sense of these anomalies in these forecasts. Okay, so here what I'm showing you is the bias in these forecasts. Let me just sorry. Okay, so I'm going to define the forecast error as the truth minus the forecast. And here I'm running a regression of these forecast errors on a constant. And if this constant is estimated to be different from 0, the forecasts are biased. Okay, so over this sample, the forecasts were biased and they were statistically significantly biased. Okay, so that's maybe that's not hugely surprising given the fact that interest rates are falling throughout the sample, but that's the fact about this. Another feature of these forecasts is that the forecast errors are autocorrelated. So if in a full information rational expectations model, forecast errors are not supposed to be autocorrelated. And here we see that these forecast errors are indeed autocorrelated. So they have an autocorrelation coefficient of about 0.3, which is statistically significant, especially at a 6-month horizon. These are quarters. A third kind of anomaly that has gotten a lot of attention in the literature is an anomaly that Koybin and Gorodnichenko have drawn attention to, which you can interpret as underreaction to news. So here, what's going on is we're thinking about a situation where the forecast has changed. Okay, so there's a change in the forecast, and the question is whether the forecast error is correlated with this change in the forecast. So for example, suppose the forecast error, the forecast increases. Well, if the forecast increases and the truth on average is systematically above the forecast when the forecast increases, you might interpret that as underreaction. The forecast should have risen even more. So there's underreaction to news. And that's indeed what we find here. We find underreaction to news in these professional forecasts. And that's, statistically significant. So there are more of these anomalies, and these anomalies have been going on for a very long time. The sample period is 40 years. You can see these anomalies in other professional forecasts, and our paper actually does several cases, not only the nominal interest rate case, but also a GDP growth case. But I'm going to focus on the on the nominal interest rate case in this talk. There's a second set of facts that is related, or we argue at least is related to these anomalies, which have to do with deviations from the expectation hypothesis of the term structure. So if the expectation hypothesis of the term structure holds, then under that null, long yields are the bond market's forecast of future short yields. So in that sense, you can interpret regressions that are testing the expectation hypothesis of the term structure under the null that the expectation hypothesis holds as kind of forecast anomaly regressions. Okay, so one of the implications of the expectation hypothesis is that when the yield spread, so this is the spread between a long bond, an end period bond, an end period zero coupon bond. The spread between that and the short bond, the 1 period bond, when that spread is high, then that should forecast high future short rates. And if you run this particular regression, you should get a coefficient of 1. So this is the Fama-Bliss type regression. And in fact, in the data, you get coefficients that are less than 1, and especially at the short end, they're statistically significantly different from 1. Okay, so this is a typical failure of the expectation hypothesis of the term structure. A more spectacular failure of the expectation hypothesis of the term structure is that when the yield spread is high, according to the expectation hypothesis, you should expect the long yield to rise. That's a little counterintuitive, but you're trying to equalize returns. So if the yield on the long bond is high, it has to rise in order to have a low enough return to have the same return as the short bond. So the long yield is supposed to rise, and if you run this regression, then you're also supposed to get a coefficient of 1, and in fact you get a coefficient that's negative. It's not 1, it's not even 0, it's negative. Okay, so this is a very spectacular failure of the expectation hypothesis of the term structure, that the long yields fall when yield spreads are high, while the expectation hypothesis suggests that they should rise. Now, when it comes to the term structure anomalies, there's a very long literature in finance arguing that these term structure anomalies are due to time-varying risk premia. But there's also a large literature that interprets these as tests of the rationality of forecasts, and argues that these facts come about because forecasts deviate from full information rational expectations. And that literature goes back to a seminal paper by Fruit in the late 1980s. And we're going to be, so the paper that I'm drawing on in this talk is basically in this camp, in this literature. More generally, I wanted to kind of talk a little bit about the general reaction to these facts about forecasting anomalies in macro. And the traditional reaction, if you go back to the 80s and 90s, when these facts were relatively new, the traditional reaction was that this meant that forecasters were irrational, or their forecasts were inefficient. And there was a time when basically many people thought we should just not look at this data. These people are irrational. They don't have good incentives or something like that, although that's not true of the bond market. And so people were poo-hooing these kinds of survey data. Now, more recently, there's been a behavioral literature that has taken a somewhat more constructive approach to thinking about the fact that these forecasts might not be rational. But in addition to that, there's been a literature that has grown up thinking about how these facts might come about not because of forecaster irrationality, but alternatively because of information rigidities and information frictions. Now, if we think about the types of information frictions that are typically kind of the way we model information frictions in the literature, the dominant frameworks, I'd argue, are the sticky information framework that goes back to work by Mankiw and Rees, and the noisy information framework. Now let's think a little bit about these two frameworks for information frictions. In the sticky information framework, the idea is at an intuitive level that the forecasters have stale information, right? They don't read the newspaper every day. And I think this model is a perfectly reasonable model for households and for firms, for agents that are kind of only peripherally interested in forecasting. They don't pay that much attention to forecasting, so they might not pay that much attention to what's going on. But when you're thinking about professional forecasters, this particular microfoundation doesn't strike me as very appealing. Professional forecasters do read the newspaper every day. They don't have stale information. The noisy information model is similar. In that case, it's that you can't quite see the information. You absorb the information with some noise. And again, that seems like a perfectly reasonable model for households and firms. But again, for professional forecasters, that doesn't strike me as a good microfoundation. Professional forecasters they observe the relevant information without any noise. They know exactly what the interest rate is. They know exactly what GDP is, and so on and so forth. It's their job. They do it 24/7. Okay, so neither of these models of information friction strike me as kind of the right model for why professional forecasters might be succumbing to these anomalies. So what we do in the paper, is there a question?
Yeah.
Yeah. Sorry.
There's a little bit of a difference. And so what you described about the noisy information setup is kind of like, I think like how Woodford would do the Woodford kind of model would be set up. But I think like if you look at it through rational intention, what happens is like the professional forecaster observes GDP, but it's like he has to forecast 4 different other variables, and when combining somehow the information in his head, there is some noise that gets attached to it. So I think like in terms of like interpreting as this like rational attention noisy information, it's like cognitive noise rather than an actual like inattention.
Well, I think mathematically it boils down to there being noise in these signals that people have. So I think mathematically it lines up relatively well with this intuition. Now, I think at some deep level, you're right. There's some deep. So I'm going to be on the next slide arguing for a slightly different viewpoint. And there's going to be some sense in which what I'm going to be saying they don't know is the parameters, while kind of the usual interpretation of the noisy information thing is that they don't know the data as opposed to the parameters. They know the model, but they don't know the data. Well, I'm going to be saying they don't know the model, but they do know the data. Now, there's at some deep level when you have unobserved components and so on, it's not always completely clear, what is a parameter and what is a state and so on and so forth. So I'm with you that there's some gray area here. Totally, that's fine.
John, just since you've paused, I'm gonna throw in one from the floor, which came in from Imeric Connery, and it essentially boils down to whether or not the forecast from the market could be wishful thinking. Now, one thing this sort of got me thinking about was this reflection problem. If I'm the markets and I know that, let's say I would benefit from lower rates or higher rates, then if I know the data is being analyzed by the FOMC and they're sort of not wanting to surprise us much, then actually we may have incentives to sort of keep prices where we want them in order to endogenously affect the policy that we see. It's very different to these informational friction stories, obviously. But have you thought about that?
That's not exactly something I've thought of. There's in the bond market, there's a lot of money on the table, so if you're right in the bond market, you can make a lot of money. So that would go against this kind of an explanation, I think. But I think the idea is that maybe, there's some groupthink in this direction that might work in this way. That's possible. I certainly think, and that'll come through, I think, in the rest of the talk, that I'm going to be telling kind of a Bayesian learning, rational learning story. But some people, when they see what I say, they want to interpret it through the lens of a behavioral story. And I think there is a way of interpreting what we do as a behavioral story, but it's more an issue of like lack of perspective, that people don't realize how different the future can be from the recent past. So I haven't, the wishful thinking is a little different from that. I haven't thought exactly about that possibility.
Okay, thanks.
John, could I also ask a quick question, maybe about a complementary informational frictions? I'm actually thinking about frictions in communication. So I'm thinking in particular like herding among analysts and the kind of Stein reputational concerns models, where, okay, there has to be some underlying uncertainty about the state of the world or data generating process in order for these things to matter, but that you can have rational analysts who start to skew their stated forecasts in a way that basically supports their reputation. So you might pander to the prior of the investment community and therefore fail to update your models quickly enough.
Yeah, I think that's that's surely going on in all of these things. You know, the bond market, of course, with all the money at stake, it's less easy to make that story work there. But you know, I don't want to. I'm sure that there are reputational concerns, there are career concerns going on among the forecasters. So that's definitely a part of the story, and I'm kind of ignoring that. That's right. Okay, so I'm gonna tell a story which is I think of as sorry, I think of as different from these stories, although there's this gray area we talked about, and that is that, you know, a more appealing, in my mind, micro foundation for lack of information is that the professional forecasters don't know the data generating process. They you know, we usually make the assumption that people know the model, and that seems to me a very strong assumption that we don't know the model. Okay, and so instead of assuming that people know the model, I'm going to be trying to think about what happens when you're learning about the data generating process. So, you know, it's well known and has been well known for a long time that parameter learning about the data generating process can lead standard rational expectations tests to fail and can kind of fundamentally change the dynamics of forecasts. And this is something that, you know, there's a long literature going all the way back to the kind of very early days of rational expectations that has made this point. So that point alone is not new to our paper. Okay, so we're going to run with that point, but it certainly exists in the literature. The thing that I think has led this branch of the literature to stall and not kind of, you know, make, you know, this hasn't become, for example, the main modeling framework for thinking about this, is that it's very hard to solve realistic parameter learning problems. Okay, so most early work, you know, that was done 20 years ago or something, or 40 years ago, they, you know, due to the computational complexity of solving a parameter learning model with Bayesian learning, they had to use very simple models. And it turns out that if you have a very simple model, Bayesian learning is fast. Okay, so, and with fast Bayesian learning, you learn everything pretty fast. Okay, and since these anomalies have persisted for decades, that kind of a story can't work if Bayesian learning is fast. Okay, so I think there was, you know, that literature kind of led to a general perception in the profession that Bayesian learning is fast, and therefore Bayesian learning can't explain things that persist for a long time. And you know, I think prior to our paper, I think it was unclear, although there's some you know, some recent papers that are making a similar point. It was quite unclear whether Bayesian learning could quantitatively work in explaining things over decades. Now, what we are going to do, you know, now that we have bigger computers and so on, is that we're going to attempt to solve a much more realistic model. And in particular, we're going to use a model that has several unobserved components. So in the case of interest rates, it's a shifting endpoints model. And we're going to show that in this kind of a framework, learning can be very hard. And actually, it's kind of amazing to us that worked on this for a long time, how much learning slows down when you complicate the model. You actually don't have to complicate the model that much, and learning goes from being extremely fast to being glacial. Okay, and at that point, when learning has become glacial, you can, and that's what we're going to show, you can generate anomalies that persist for a very, very long time, you know, in a Bayesian rational learning setup. So that's what kind of the object of our paper is. Okay, and the basic idea is you have to have a model where there are kind of two things that are close to observationally equivalent in the data. So though their high frequency implications of those two things in the model are similar, but they have very different low frequency implications. And so they're very important when you're trying to forecast long run phenomena. But since they have such similar implications for high frequency phenomena, you can't tell them apart unless you have like centuries of data. Okay, so what are we going to do in the paper? We're going to consider a Bayesian forecaster we're going to endow this Bayesian forecaster with an unobserved components model and some initial beliefs about the parameters of that model. Then we're going to have the agent learn in real time using the actual real world data, and then generate real-time forecasts at each point in time, and then compare those real-time forecasts of the agent in our model with the actual forecasts in the real world, and show that our Bayesian agent can replicate, all the anomalies I showed you before. Now, from the perspective of this particular talk, where we're in the back of our minds, we're thinking about central bank communication, I want to highlight a few features of the model that we're going to use. So in our model, the forecasters are going to be using only past short rates to learn about the data generator. So basically, we're interested in the data generating process for the short rate. And they're only going to be learning using past short rates. So they're not going to be using any other variables like output, inflation, anything else. None of that is going to enter their forecasts. But in addition to that, they're not going to be using any central bank communication. They're not going to be using forward guidance. They're not going to be using the fact that Volcker became, chairman of the Fed and started talking about how he was going to bring down inflation. Those kinds of things, all that central bank communication is not going to be playing a role in generating the forecasts in our model. Okay, so the data we use is data on short-term interest rate, 3-month Treasury bills back to 1951, quarterly averages. We're going to use zero coupon yield curve data from Liu and Wu in order to create those expectation hypothesis regressions. And then the forecast data we're going to use is the survey of professional forecasters, and we're using the mean forecast at each quarter. So this is the variable we're interested in, the data generating process for. This is the 3-month Treasury bill rate in the United States. You can see how pathological the behavior of this interest rate series was over this sample period. And prior to the sample period, the US had basically been on a gold or silver standard for, all of history. And so interest rates have been quite stable. And then they do this crazy thing over the sample period. So here's the model that we use. Okay, so let me walk through this relatively slowly, and please ask me if anybody has questions. So Y here is the 3-month Treasury bill rate, so the observed variable. And we're assuming that Y is made up of 2 components, mu and X. And mu follows a random walk. Okay, so the mu dynamics, to the extent that there are mu dynamics, they're permanent. So this is kind of like the inflation target, something like that, something that's permanent. And then X is an AR1. So X follows, dynamics that are persistent in the short run, but in the long run, they die out. And this model has 3 parameters. Okay, so there's the persistence of the AR1, that's this row here. And then there's the overall volatility, that's sigma. We've done a version of this with stochastic volatility, but in the end, we threw that out. That didn't contribute to any kind of interesting point, so we threw it out. But you can definitely add stochastic volatility. And then the third parameter, gamma, is telling you the fraction of the variation that is hitting the random walk component, and then the complementary fraction is hitting the AR1 component. Okay, so this is the model. It's a 3-parameter model. It's in some sense a very simple model, but actually learning about this is glacial.
So John, so here you're describing the data generating process.
No, sorry.
No,
Nobody knows what the data generating process is.
Okay, so this is the forecasting model that
This is the forecasting model, right? So the idea is that we're really trying to put ourselves in the shoes of a real forecaster that doesn't know what the data generating process is. None of us know what the data generating process is for the 3-month Treasury bill rate. Okay, but we have some internal model that we use to think about what is going to happen. And this is that model, the model that the forecaster is using. Thanks for pointing that out.
Yeah, so I wanted to ask about that. So in the language of kind of a large learning literature, this would be the perceived law of motion.
Yeah.
So the question then is, this is likely misspecified given that the probability that this coincides with the true model is small. So the question is, what are the implications of entertaining this particular form of a forecasting model and not some other? So for example, not some simpler time series model or a VAR type framework or something like that.
Okay, so let me say a few things on that point. First of all, so we're going to be in the business of trying to explain what actually happened. Okay, so in order to explain what actually happened, we need a model where learning is very slow. So some of those simpler models are not going to work. Learning is going to be very fast. So if you think that's the true data generating process, then learning is not important. Okay, but if you think this is the true, if you think this might be the true data generating process or something close to it, or sorry, it doesn't have to be the true one. If you think this is the perceived data generating process, then learning might be playing a big role in explaining these phenomena that I showed you before. That wouldn't work if it was an AR1, for example, because that's something that's easy to learn.
Okay.
The other thing is, just a second. The other thing is that you might be worried that some of the results that I'm getting is because my perceived data generating process is misspecified. And so we have a section in the paper where we do Monte Carlos, where we generate data from this. So this in that section of the paper, this is the true data generating process. And then we use this true data, we say that the perceived one is the same as the true one. So they're not learning using a misspecified model. And we generate the same kind of results given certain initial beliefs. Okay, so I think it's not just the fact that we're learning with this misspecified model that leads the learning to be slow. We show in the paper that with this data generating process, the learning would be slow, even if it were the true data generating process.
Okay, cool. So can I interpret what you're doing as saying that we really need professional forecasters out there to entertain this particular form of a perceived law of motion in order to generate the forecasting anomalies, because this is what you need to slow down learning?
Well, I wouldn't say it's this particular form. Of course, I had to write down something specific, but the more general point is that if they entertain a perceived law of motion, which is hard to learn, then they're going to be confused potentially about the true parameters for a very long time. That's going to be the main point. This is a particular example. I'm not hostile to the notion of making this even more complicated. The world is probably more complicated. This should really be a VAR with unobserved components and so on and so forth in reality. That would, I think, my intuition, and there's no theory here, but my intuition would be that that would make the learning problem even harder. But you at least for the explanation that I'm going to give to work, you need the learning problem to be hard. This is an example of a case where the learning problem is hard. I'm sure there are others.
Okay, thanks.
Okay, so this is the model. This is the perceived law of motion. Okay. And so then what people are going to do with this perceived law of motion is they're going to engage in online estimation and to mimic the problem of the forecaster. Online estimation just means that they stand in a certain point in time. So starting in the 1950s, they're going to get a data point, which is the actual realization of interest rates, in Q2 1951. They're going to update their beliefs. They're going to forecast given their beliefs. Then they're going to observe the actual interest rate in Q3 1951, update their beliefs again, forecast again, and so on. And we're going to roll this forward as people observe more and more data on the interest rate. They're going to, and these are always the actual data on the interest rate. They're going to forecast again and again each quarter. And then we're going to have a data set of the forecasts from our model. And we're going to think about how the forecasts from our model relate to the forecast in the real world. Okay. Now, in order the notion that learning is slow, which I've been emphasizing, it implies that the initial beliefs are going to matter. Okay, so if learning were fast, the initial beliefs would quickly be washed away, and the only thing that would matter would be the data you see eventually, you know, pretty quickly. But if learning is slow, the initial beliefs are gonna matter for a long time. So it's really important what these initial beliefs are. They're actually going to be driving the results quite a bit, you know, or they're going to totally be driving the results. Okay, so the name of the game here is, you know, is the model that I laid down a reasonable model? Is it reasonable that people would perceive, you know, something like this as the perceived law of motion? Okay, and is it reasonable to think that people had the initial beliefs that I'm going to endow them with? You know, and if that's true, if you think it's a reasonable model with reasonable initial beliefs, then you might think of what I propose as an explanation for all these anomalies as a reasonable explanation for the anomalies. Okay, so I'm not gonna like skip the slide on the initial beliefs. That's really central to what's going on in this analysis. So what we're gonna do is we're actually gonna search over the space of initial beliefs. Okay, so we're gonna posit some particular family of distributions for these parameters. Rho, remember, was the persistence of the AR1 component, and we're gonna say, oh, that's gonna be a normal distribution. And so that's a 2-parameter family of distributions. We're going to be searching over these parameters to try to find initial beliefs that explain the anomalies. Same thing for gamma. So gamma, we're going to posit as a beta distribution. We're going to be searching over the parameters of the data beta distribution to try to find a set of initial beliefs that generates the anomalies that I showed you before. Okay, so these are 4 parameters that we're searching over. We're going to fix the parameters on sigma. It turns out the beliefs about sigma are not as important, so we're going to fix those at something highly dispersed. So what's going on here is that we're basically searching over this 4-dimensional space to try to fit the 6 anomaly regressions at the different horizons. So we have 29 target moments that we're interested in fitting and 4 parameters that we're trying to use to fit them. And then in the background, we also have a constraint that we want the initial beliefs to be quote unquote reasonable. So we also put some constraints. We don't want to be thinking about the parts of the parameter space where the initial beliefs are not quote unquote reasonable. Okay, so I'll show you the initial beliefs a little bit later. Okay, so let me just show you how well we did. You know, basically this works. All right. And so here's the results. So here's the bias. Okay, so this is the bias in the data, and this is the bias from the model. So the model generates a bias that's very similar to the bias in the data. Here's autocorrelation. So this is the autocorrelation that we saw in the actual forecast of the survey of professional forecasters. Here's the autocorrelation of the forecast over this 50-year period in our model. So we actually get more autocorrelated forecast errors. You know, these are the Bayesian agents. They're generating even more autocorrelated forecast errors than the actual agents in this case. Here's the underreaction to news. We get underreaction to news that's of a similar magnitude as in the actual data. It's rising with horizon, just like in the actual data. Here are the results on the expectation hypothesis. These are the facts that are hardest to get. Okay, so some of these earlier facts are easier to get. You can get them with simpler models. But the ones that are kind of pretty tricky to fit very well are the results on the expectation hypothesis. Okay, and so here you see like what looks to me like a spectacularly good fit. We get, you know, in the real world, it was close to 0 at the short horizon, close to 1 at the long horizon. And that's what we get, close to 0 at the short horizon, close to 1 at the long horizon. And finally, the change in the long rate regressions, there it was -1 at the short horizon, -2 or 3 at the long horizon, and that's what we got. -1 at the short horizon, -2 or 3 at the long horizon. So basically, we can fit all of these anomaly facts with Bayesian learning.
If you look at comparative statics, so there must be moments in time where people learn faster than others, and there are larger movements in interest rates or something.
Sorry, can you repeat it? I'm having some trouble hearing you.
Oh, sorry. So there must be like moments where agents learn faster than others. So like when there are large movements in interest rates, presumably the agents are learning faster than when interest rates don't move very much. So it would be interesting to see how the model does compared to the data.
Yeah, so I'm going to show you that. Okay, let's hold that thought. That's actually the slide that I'm going to spend the most time on. Is just I'm going to just show you all the forecasts. Okay, so let's have that conversation in 2 slides. All right, before I show you that, let me just show you the initial beliefs. Okay, so these are the initial beliefs that generate that good fit. Okay, so it's the model I showed you before and these beliefs about the parameters. So this is in 1951. Of course, the world didn't start in 1951. I'm going to have to start my analysis at some point. I started in 1951. That's when the Treasury-Fed Accord occurs, when basically the central bank gets independence again from the Treasury after World War II. Okay, and so the question you're trying to ask yourself when you look at this figure is this a reasonable thing for people to believe in 1951? Okay, so prior to 1951, the US, outside of war, had been on a gold and silver standard for most of history. So long swings, long random walk-like swings in interest rates had kind of never been seen before. And so you'll notice that gamma, which is the fraction of the variation that's hitting the random walk component, the initial beliefs are putting a lot of weight on relatively low values of gamma. So people believed, according to what this explanation of these phenomena, that in 1951 people didn't really put a lot of weight on the notion that there would be big random walk shocks in interest rates. Right? They put some weight on some random walk shocks, but most of the weight was on pretty low fraction of the variation coming from random walk shocks. Actually, these beliefs will then get updated over time, and towards the end of the sample, the posterior is somewhere over here. Okay, so they update their beliefs to something between 0.2 and 0.3 over time. But initially, they believed it to be even lower than that. In terms of the persistence of the AR1 component, it's just a pretty wide prior over the reasonable range of parameters. Okay, so they put some weight even at very persistent values. They put some weight on less persistent values. Over time, they update these beliefs in the up direction, and towards the end of the sample, the posterior is somewhere here, right? But there's no way of knowing ahead of time what was going to happen. So there's no reason to believe that they should have had priors that were centered on the truth in 1951, and that's the crux of the explanation. They started off with initial beliefs that are low relative to what actually happened over our sample, and that's what's generating these anomalies in the particular direction that we see them in the data. In that Monte Carlo exercise I mentioned before, we show that if the initial beliefs are too high, as opposed to being too low like they are here, if they're too high, you get anomalies in the other direction. You get negatively autocorrelated forecast errors, you get overreaction, and so on. But if you have initial beliefs that happen to be too low relative to what is the kind of quote unquote true value that would have explained the data the best in sample, then you get the kind of anomalies we saw in the actual data. Any questions about this?
Michael Bauer has a question. I don't know if it's about that, but he has hand up. Mike, just in general, speak.
Yeah, so this is kind of about maybe 2 slides ago about the expectations hypothesis regressions. So if I understand correctly, then, I mean, you're constructing the long-term interest rate under the expectations hypothesis, right? Based on the agent's subjective forecasts at the time.
Yeah,
so,
that's right.
So if the expectations hypothesis is true, then the agents should look at long rates and get a lot of information.
No, not at all. Because the long rate is generated from their own forecast. So the long rate doesn't include any additional information, because the long rate is just generated by their forecast. Well, if the expectation hypothesis is true, then the long rate is just their own forecast about. So we don't have any heterogeneous agents. In a world with heterogeneous agents with heterogeneous beliefs, then one agent can learn from long rates about other agents' beliefs. And if they actually pay attention to that and want to learn from other agents that have other pieces of information, you're right. But in this world where we're ignoring any heterogeneous beliefs, then the long rate doesn't include any additional information.
So there's two long rates, right? There's the one at time t that comes out of the learning model and the expectations and the parameters. And then there's the one that you actually observe in the data.
No. So sorry. So we're thinking of these agents. We're running the world of the agents forward, you know, totally separately from the real world. Oh, except that they see they always then see the true short rate. Okay, but the long rates that they see are just the long rates that they generated. Okay, the only information that we're giving them from the real world is what happens to the short rate, and then we're trying to see if the term structures that they generate over time look like the term structures we see in the real world. We never give them the actual term structure. You're right. That would give them a lot of information, but the idea is to mimic the real world. The real world is one where you don't get like some, you know, peek at, you know, God's data generating process, right? And so we're mimicking the real world. There's some actual short rate generated by the central bank. That's what they actually, the input they get. And then the bond market is just generating the term structure. And that's happening in our parallel universe in our model as well. Okay. Okay. So the last thing I wanted to talk about is this picture here. And this is kind of in some sense where we're going to bring this all back to central bank communication and back to what I said at the beginning. So here, the top panel is that same picture I showed you at the beginning. It's the forecasts and the actual short rates and how, you know, unsuccessful the forecasters are at figuring out what the Fed was going to do. And maybe part of that is because the Fed itself was unsuccessful at figuring out what it was going to do itself. Now, compare this to what comes out of our model. Okay, so this is what comes out of our model. And, you know, to me at least, there's a remarkable resemblance. Okay, so take this easing episode here. Okay, so it looks very similar to this over here. Interest rates are going down, but they perceive interest rates as going up throughout. That's what happens over here. Same thing over here. They perceive interest rates as they're going to rise pretty soon. That's what happens over here in the model. They perceive these increases in interest rates. Take these tightening cycles. They perceive the tightening to be slower in the model, just like in the data over here and over here. You know, the 1990s, nothing much is happening, but in this tightening cycle, they again perceive the tightening to be slower than it actually was, just like it was in the data. And then in this easing cycle, they perceive less easing that actually happened. Okay, so our model is very much, I think, capturing how the bond market is behaving. Or actually, this is professional forecasters. Okay, so how professional forecasters are behaving. And this, as I wanted to emphasize what I said before, this is when we are assuming that they're only using past short rates. So they're completely ignoring all the things that Volcker said about how tough he was and how he was going to bring down inflation and anything else, any other communication by the central bank. Now, obviously, like prior to 2000, the Fed was pretty opaque, but it is notable that in the Volcker period, where Volcker really was trying to bring down inflation, you know, they were just, it seems like they were just going along, looking at what happens to short rates and learning only from past short rates. And then more recently, this changes pretty dramatically. Okay, so in our model, we do not endow the agents with any forward guidance. But look at this episode. Here is an episode where things are very different. It's not like over here or over here. Okay? Sorry, this is a tightening cycle. This is a tightening cycle. This tightening cycle is very different. Here, the market gets it right. The professional forecasters are exactly on target. They know exactly how fast the Fed is going to tighten policy. In our model, we're not endowing them with the forward guidance that the Fed did at the time. And so they make exactly the same kind of mistake they made at all the other tightening cycles before. I argue that the reason for this is that this is the first tightening cycle where the Fed makes successful use of forward guidance. So this is the this is the tightening cycle where the Fed said, we are going to raise rate at a moderate pace. And it was interpreted as 25 basis points per meeting for the foreseeable future. And that's actually what they did. They tightened by 25 basis points per meeting for a very long time. The market understood their communication and got it right. And our model, is showing you what would have happened without any forward guidance. I think that's the way I interpret this. So forward guidance really dramatically changed the game here. Okay. So this is one example. Here's another example. They're getting it wrong early on in the Great Recession. They think there's going to be takeoff. And our model guys are just like that. They think they're going to be takeoff very soon. Then at some point in 2012, they explicitly tell the market, there's not going to be takeoff. You guys are totally out to lunch. We're going to be here for many years. And the market believes them. The forward rates and the forecasters, they collapse to zero. In our model, we don't endow them with that forward guidance. And that's not what happened. So they continue to make the same kind of mistakes. And here's a third episode, okay, the tightening cycle in 2016 through 18, where the Fed again seems to have communicated through forward guidance, I believe, very successfully how fast the tightening was going to be. And I interpret our parallel universe as what would have happened if the Fed had not started engaging in this large amount of forward guidance that it has over the last 20 years. And so the way I interpret this picture is to show just how important forward guidance is and how powerful it is. And I think that, so my conclusion from this whole thing is traditionally the Fed has been exceptionally unsuccessful at guiding expectations about policy. Forecasters usually act as though the only thing they can learn from is past rates. Recently, however, forward guidance has dramatically changed this. We've seen a very successful forward guidance episodes during the tightening cycle of 2004-2006, the zero lower bound period of 2012-2015, and the tightening cycle of 2015-2018. So obviously, long rates are what matters. Guiding expectations about the path is central and essential to good policy. And this means, in my mind, that forward guidance is central to good policy. And here, what I want to emphasize is that it's not just forward guidance about the next few meetings. If you look at the statements of the Federal Reserve, they typically are making statements about the next few meetings. But really, to be ultimately successful, you should be guiding things about the next few years. And the statements are not very good about that. Sometimes they are somewhat successful at that, but usually they're not. And this year, for example, I've been pretty unhappy about the way in which they've communicated this. Okay, so I think the discourse is still too focused on the action and the short-term guidance. And in particular, the policy recommendation I want to make is that I think the Fed should publish dot plots after each meeting. I think it's ridiculous that they only produce this. The place where the Fed really does some long-term serious quantitative forward guidance is through the dot plots. And they only publish them after every other meeting. And I totally fail to understand why they wouldn't use this incredibly powerful tool to guide the market after every meeting. So let me open it up for a discussion now.
All right, thanks very much, John. Super interesting. There's a few. So let me pick up a couple of things from the wider audience before we go into further discussion. So, Catherine Mann, I think this was more just an endorsement of one of the earlier comments. But as someone who worked with both SPF participants as well as the traders on the floor, there's substantial difference of views on short rates for the SPF versus actual market participants, particularly at high frequency, along the lines of the previous commentator. And I can't remember if that previous commentator was Dan or Alex, so we'll attribute it to both of them to give just some credence to that. And then Pierre Siklos asks, forward guidance is usually conditional. Forecasters ignore the conditionality. So I'm going to chuck that in. I'm going to add one on top of it from myself, and then we'll go to Michael Ehrman, who's raised his hands. And that is, I guess it's not in your model, but and it's sort of in the spirit of what Dan was somewhat mentioning. Communication failures could also be because the central bank is also not aware of the structure of the economy with any great perfection. It's slowly learning about this. And therefore, this issue of credibility that you started out mentioning seems like, you know, there is a worry about how they establish and maintain credibility in this slow-moving, evolving world that they face. Now, interestingly, I was recently part of a Bank of England conference at which Deputy Governor Ben Broadbent spoke, and he spoke almost at the opposite end of the extreme about the use of forward guidance, in the sense that he disliked the idea that we would commit to anything beyond the very immediate decision. With his worry, and I'll be honest here and open, I'm closer to you on this, but you know, his view, just so it's out there, was that the risk of longer guidance is that it's misinterpreted as a commitment or a promise, and therefore credibility is on the line at the moment. You know, you sit here today and you say, I think rates are going to go up to 4, when actually in the future, you know, some other big negative shock comes and I never go up to 4, or worse, you know, no shock comes and I need to do even more and I go up to 6. And in either case, you know, there's somehow, you know, the markets lose trust in me as a central bank. So I guess I've put out a load of things there, so let you take them.
Yeah, let me take a few of these things. So I agree that forward guidance is conditional, and it's obviously something you can do to just like not engage in forward guidance, and then you're going to be in this ballpark where the market never knows anything about what you're doing, and the power of your monetary policy is much less than it otherwise would be. So I think at the very least, the people that are skeptical about forward guidance, they should recognize how much they're giving up. Right? They're giving up an enormously powerful tool where they can, you know, like in this episode, move the term structure enormously relative to what, you know, I'm kind of saying it would have done without the forward guidance. So there's really a lot to lose from not doing forward guidance. But, you know, of course, it's true that there are risks associated with engaging in forward guidance having to do with misunderstanding the forward guidance. But given how much there is to gain from forward guidance, it seems to me that the Fed should be trying to engage in explaining this stuff. So I agree that forward guidance, which is not supposed to be a commitment, but rather a forecast, can be misunderstood as a commitment. But the Fed should engage in trying to explain to the public that distinction. And who's to say that they can't do that? Are we really all babies out here in the market that can't understand that distinction? They really are treating, I think, the market like babies. Now, I think to some extent that is justified because the market is, you know, exceptionally unsophisticated, I think. But you know, I think it goes too far. Now, I also think that the central banks in general, and I'm mostly speaking about the Fed because I follow the Fed more than other central banks, are extremely averse to having to reverse course. They have some amazing aversion to this. But I think that's self-fulfilling because they so seldom reverse course. The market puts a lot of weight on the notion when they reverse course, but this is all a bad thing. They should, if they were just willing to reverse course more often, it would be not as much of a big deal when they reversed course. And so I think they've gotten themselves into a bind because they're so unwilling to reverse course. And in particular, in this particular year, you know, I was advocating, and now of course it's become the standard view that they should raise rates quite quickly. But I think what was going on was that they were so worried that they might have to reverse course that they were not willing to tighten policy. And that was starting to become a very, very costly thing earlier this year. Now they've gotten over it, thankfully, but I think that's something they need to move away from.
Okay, we'll go Michael Ehrman and Julia.
Yeah, thanks a lot. And this was a fascinating talk. I have a comment that's related to Michael's earlier comment. Is, you know, do central banks know better actually? And you know, you can draw, I think, a very similar chart to the one that you have up here right now for other central banks that actually provide forward guidance. So there's a couple of central banks that have sort of the projected interest rate path, like Norway or Sweden. If you plot their charts, they look pretty much exactly like the chart you have up there, right? And so I think it would be really interesting to run your model for the central bank forecast itself. You can't do this for the Fed because you don't have that data, but you could do this for Sweden and Norway. And then you could actually see whether the central bank does any better than the SBF forecasters for those countries. My hunch would be they don't. The charts look exactly like what you show here. And if they don't know better, then indeed, there could be a big risk in giving forward guidance, right? You might be losing credibility because you actually have to, you're not going to be sticking to what you said you might do. There's also this question, if you provide forward guidance, but you're very uncertain yourself, and the market starts reacting to that, you're sort of generating this echo chamber effect that, the market just mirrors what you said, and you might want the market to actually have a different opinion if you're very uncertain yourself. So I think understanding to what extent the same uncertainty also applies to the central bank itself would be really interesting. And then just sort of a follow-up on the point you made that central banks are very unwilling to reverse course. I very much agree with that. I mean, it's striking to see that in the data, but wouldn't that imply that the market should not do the mistakes that they do? Because every time you see an easing, the market expects a tightening. Every time you see a tightening, the market expects to see less of a tightening. So it doesn't seem that the markets have incorporated what you just said. So isn't that surprising? Thank you.
Yeah, your last point is interesting. I have to think more about that. I don't have anything constructive to say about it. On your first point about central banks, whether they know more or not, yeah, I mean, so that's possible that the central banks are just as out to lunch about this as the market. So I've of course provided a rational reason why this would be very hard to know. That my model was a Bayesian model, and so maybe it's just rational not to be able to do this very well because this is fundamentally very hard. That's possible, and in some instances that's almost surely the case. Now, I do think though that some of these episodes where the Fed did engage in forward guidance recently give you good examples of situations where that's not the case. And it would be interesting for me, I agree with you, to look at Norway or other central banks that produce projected interest rates and see whether something like this happens in their cases. But this episode, obviously the Fed understood it wanted to tighten for a while. This episode is, I think, the most spectacular one where the Fed was coming to terms with its own use of forward guidance. And I think in retrospect probably wanted to make, they just hadn't figured out how to exactly do it. They were using these language for some time, for a considerable period and so on. And none of this stuff was really breaking through into the market in the way I think that the Fed wanted it to until they came up with this language, at least until this point, which it did have this issue of commitment associated with it. But this is an example where I think the Fed probably knew better than the market. But maybe you're right. Maybe I'm wrong about that. I don't know. Certainly, when I saw this graph first and noticed these two tightening cycles and contrasted them with some of these other tightening cycles in the past, especially this one and this one, where I think the Fed in both of these cases knew what it wanted to do, I thought to myself, if only the Fed had access to forward guidance back here, they could have generated something like this or like this. But I agree with you. The jury is definitely out on whether this is possible in general.
Okay, Julia.
Yeah, thank you. Thank you very much for the presentation and the discussion. I will start with a basic comment. That's, central bank mandate is price stability, is not to get professional forecast right on the next move. And I think on this respect, if you, maybe discard the last few months, the Fed was quite successful after the 90s to reach its mandate. So for me, I'm sitting a bit more on the broadband side on forward guidance. Forward guidance, I mean, has been implemented as a tool to avoid a lowflation equilibrium. So that's very powerful where you are at the ELB, because you want to pre-commit to not move when things will go better in order to re-anchor inflation expectation. I'm a bit skeptical that in normal times, so when you're outside from the ELB, that's what central banks should do. It seems to me that most of the criticism about the Fed being now a bit behind the curve are related to the change in strategy that the Fed has gone through in the past 2 years, which kind of was a pre-commitment of an overshooting of inflation, even in normal times. That it's something that now we see as possibly wrong. So to me, I mean, central banks communication is key, but I should be like sort of making markets understanding the central bank reaction function without pre-commitment, because otherwise we will go into all the risks that have been explained by others and Michael especially on credibility, because we see indeed that central banks that had published dot plots, they were very wrong. So maybe markets should make their own forecast, because I don't think that we have private information that are superior to professional forecasts in this respect. Thanks.
Well, you know, the basic point I'm trying to make is that which I think everybody agrees on, which is that longer term interest rates are what really matters. So the extent to which the central bank can move longer term interest rates in a way that it wants, it's a very powerful tool. That's the point of forward guidance, is to move those longer term interest rates. And I think what this picture illustrates is just how bad central banks were at doing that back in the day. And this is the promise of forward guidance, is to be able to move longer term interest rates much, much more. I mean, I do agree that if the central bank is sufficiently, kind of doesn't know enough, if the central bank is really has no idea how the economy works, then this might be bad. But I guess I'm more optimistic about the central bank's understanding of the economy. I guess implicit in my view is a view that the central banks understand how their policy reaction function works better than the market does. But if you don't agree with that, then I can see how you would be very skeptical of what I'm saying. I mean, I'm very struck by just how poorly the market understands the policy reaction function of the central bank.
Yeah, sorry, maybe there is just a language. For me, forward guidance is a commitment. It's not like
So that's a totally different. So for me, that's not true. Not at all. There are two kinds of forward guidance. You can make a commitment, but that's a dangerous game, as you say. But you can also just explain to the market each time what you think you're going to do. Okay, you think the current situation means that what you're going to do take the current situation right now. The market currently believes that the Fed is going to raise interest rates to about 2.5% or 3% by the end of the year. And there were dot plots back in March that kind of helped the market get guided to that point. But the Fed can tell the market what it thinks it's going to do on regular intervals to try to help the market understand, the policy reaction function. And over time, as the market sees more and more of these helpful nudges, the market might understand at least what the Fed thinks the policy reaction function is. The market might, in the end, disagree with the Fed about what the policy reaction function is, maybe because the market thinks the world works differently than the Fed thinks. But that's how I think of most forward guidance. Forward guidance as a term didn't exist back in 2004 to 2006. But to me, this is forward guidance. and actually very successful forward guidance.
Okay, let me just quickly jump in. I do want to end very soon. I said hard finish, but I'm going to relax the constraint just a little bit because I'm enjoying this too much. Catherine, I'm going to ask you to come in. You had a point about dot plots at every meeting, but also have, as someone who's sat in the markets for a long time, your views on this would be great. Let me just add one thing that Petra Geertz mentions in the comments, that of course, if you don't want to be misinterpreted as a commitment, you can publish fan charts essentially around what you say and sort of try to acknowledge the uncertainty there. But Catherine, why don't I let you add a minute or two of comments, and then after that, I promise I will finish.
Well, thanks very much. You know, this really has been a very interesting discussion, and I like the empirical assessment as well, and showing sort of it's interpreting what forward guidance might have done in those last couple of decades. So a couple of points that I want to draw out from other people's comments, and then make some thoughts about how to improve on or sort of extend the empirical exercise. So on the comments, I made a comment that SPF are not the market. You know, the survey of professional forecasters, if you look at who they are, so an interesting exercise that that we do and have done at various times when I was at Citibank, for example, is to compare the SPF with the market traders, especially at high frequency. And you're going to see that there's quite a bit of daylight between the two of them. And so your model is right about the SPF, the Bayesian learning, and you know they have initial beliefs and so forth. But they aren't the ones who are making the trade. So that's a sort of a disconnect in the model and the data and the way it really works in the world that might be interesting to consider. The second point on forward guidance, the last exchange that John was having on what is forward guidance. In my view, forward guidance is explaining to market participants as well as real side participants the way we think that the economy works, the way we think financial markets work as an intermediary and transmitter of our policy to the real economy. That is forward guidance. It's not quite the policy reaction function because it's a little bit more than that. And it's absolutely not a commitment. It is this is how I think the economy is working, and my policy is to do X because I think the economy works this way, and I think the financial markets work this way. But what you can see, if you look at a Sweden situation, or for example, if you look at the votes at the place that I work now, there are differences in views on how decision makers feel that the economy works. And that dispersion is a very important communicator to both markets as well as economic participants on the real side about what the policy makers might do ultimately, because they're all ultimately a consensus. They come out with a decision and a rate change. So the dispersion around the assessment of the economy, the assessment of likely policy moves, votes, if those are public, sometimes they are, sometimes they aren't, depending on the central bank. And using that information, I think, would be an additional, additionally value, give you value on what it is about forward guidance in this broader sense means. And I guess the last point that I would make is that the environment that we are in right now is one where dispersion is particularly high. Dispersion of SPF, dispersion in the markets, and dispersion amongst central bank participants. So in general, when thinking about the sort of the underpinning, the data underpinnings in the model, it's not just the yield curve that is relevant. It is also the dispersion around the median yield curve that's in there, and the median vote that there is, or median short-term rate that is in there. And I think that using some more work with other moments of the data might have additional value for your econometric exercise.
Okay,
Yeah,
John,
so-
last word over to you.
Yeah, so let me respond a little bit to those points. First, we also fit the bond market, very well. So that was the point of these expectation hypothesis regression. So our model does really well on SPF, does really well on the bond market. And I think I could produce a picture like this for the bond market and it would look very similar. I should do that. On the point about dispersion in views, I think actually that's a very important point. And I actually, that's one of the reasons why I like the dot plots. There's a lot of controversy about the dot plots, right? And one of the things about the dot plots is that it shows all the dots for the 13 people or whatever it is. And some people don't like that. And, maybe the chair wants to just have one dot and it be his dot and so on. But the dot plot has that benefit that it shows these different views. And I think that's a real strength of the dot plots. And I think it's a strength relative to the fan charts. I think probability distributions are hard to understand for regular people, but the views of 13 different people or whatever it is, that's, I think, easier to understand and can highlight, how people disagree. And so that's, I think, a really nice feature of the dot plots. I know that many people disagree with that view, but that's my view, I kind of feel like the Fed hit on a very nice way of communicating forward guidance with the dot plots. I just wish they would do it more often.
On that, I am going to again thank John and everybody else for this wonderful talk. John, you have definitely earned your morning coffee today, since your day is only beginning. For the rest of us, we're coming to the end of our day, and I wish you all a very, very enjoyable evening. And yeah, we'll circulate details of the next one, which is in a month from now. Okay, thank you very much. I'm going to clap on behalf of everybody else. Thanks, John.